The biggest lie about dividend stocks, that they're a guaranteed income stream. I'm here to talk to you today about the ugly truth behind dividends. The first ugly truth is that dividend stocks are not safe investments. Too often I see and hear from people, especially the do-it-yourselfer type of individual, that they're going to put their entire portfolio in dividend-paying stocks because they're safe. Now, often dividend-paying stocks are established companies. You think about the blue chip type of companies, Coca-Colas, and things of that nature. That's not always the case. There's something what I call the value trap that you need to be aware of, and that is new or maybe even troubling companies will attract investors with high yields, but at the end of the day, the underlying company is not financially sound at all. I'll give you an example here is, let's take a stock that is worth $50 per share. They announced that they're paying a $1 per share dividend, which is ultimately a 2% yield. What happens if that stock price drops from $50 per share to $10 per share? They're still paying a $1 dividend, so now all of a sudden they have a 10% yield. And many times investors will fall trap and go, oh gosh, we have to get into this stock that's paying 10% yield. Well, there's a reason that the stock dropped from $50 a share down to $10 per share, and it's typically that their fundamentals are way off. And so don't fall trap to just looking at a overall yield on a company. That does not mean that they are a safe investment. The dividends at the end of the day many times can be offset by poor performance. Let's just say that you are collecting 4% from your portfolio and you think that you're not touching principal because you're just taking the dividends. Well, if your portfolio drops by 30% because you're not in sound companies, then who really cares about the dividends at the end of the day? Your withdrawal rate is now going up drastically because you're touching way more than the principal because your performance declined. All right, number two, ugly truth is that there's this major misconception out there that dividends are extra return from the company. That is not true. At the end of the day, the price value of the shares decline by the amount of dividends. Meaning, again, you have a $50 stock price and they are paying a $1 per share dividend. On the date that they're paying that dividend, the stock price will actually decline by $1. And so the price value of the shares are declining by the amount of the dividends. So it's not an extra return. I want you to think about it this way. A dividend is ultimately a forced sale of the company. You are receiving money from that stock that, in theory, they could reinvest back into the company. That leads me to another one I'm going to talk about. But, again, think about a dividend as more of a forced sale, creating some income for you, but it's not a guaranteed income stream as well. At any given point, a company can either decline or totally get rid of that dividend. Think back to 2020. Many companies had to suspend their dividends or got rid of them altogether. So don't chase returns and fall victim to thinking that a high dividend or a high yield means higher total return to you. All right, number three, only investing in dividend-paying companies will reduce your overall growth potential. Now, historically, let's say the S&P 500 is going to perform better when you have the dividends reinvesting. I'm not saying that that is not true. However, if you're not investing properly and diversifying yourself and you're putting all of your assets in high dividend paying companies, again, that means that these companies are not reinvesting back into the company, therefore limiting the overall growth to the company. So when you hear value stocks versus growth stocks, they're both important to have. Now, I said they're not safe when they're paying dividends, but generally one of those blue chip type of companies could be a great diversification tool. But you also want to make sure that you have some companies that maybe aren't paying dividends that are more focused on reinvesting back into their company and looking for higher growth. So make sure you have a diversified growth plan that includes, let's say, both blue chip dividend payers, but also some of the higher growth stocks as well. And now, this is all relevant to whatever your risk profile or risk tolerance is. All right, last ugly truth is that dividends are not tax efficient. So dividends in a taxable account are, at the end of the day, taxed as ordinary income. So depending on your tax situation, these can be very inefficient, especially if you don't need the income. And again, I see this all the time where people are focused on dividend paying companies, but then they're not even taking the income. So they're being taxed on these higher dividends, and at the end of the day, they don't even need the income. So these are 4 important things that you want to focus on when it comes to dividend investing. All right, so many advisors tell you that dividend investing is the best way to increase your retirement income. I'm here to tell you that's not always the case. There are many other innovative ways to increase your income, which I've covered in the video right here. Let me know your thoughts in the comments below, and we'll see you next week.